All right. How you doing? I hope you're doing fine. If you're new here, please consider subscribing. We provide valuable content here, and please also consider liking this video. So today, as you can see from the title, we're going to be looking at something very important when it comes to forex trading. Okay, so I'm going to be looking at Japanese candlesticks and what you should know, what they mean, and how you should look at them, all right, and how you trade them. This is a very important video, and I hope you can stick around and finish watching the video, because you'll learn a lot of things, especially if you're a new trader. Okay, so let's get started. So I'm sure you're familiar with this. This just shows where price opened and closed. Okay, this is a chit chat pattern of Japanese candlesticks. Okay, so we have two things here. We have a bullish one and a bearish one. So what is it saying here? So we have a market which opened low right here, and price, the buyers took price and pushed the price up to this high. Okay, and then the sellers try to take price lower, but it closed bullishly. Therefore, the open is always above the close, and the opposite is a bearish one. So this one, it opened where? On top here, and the buyers tried to take price higher, but they failed, and sellers came in and took the price lower. Again, the buyers again tried to take price higher, but they failed and it closed lower than it opened. Therefore, that showed bearish momentum. A candlestick is formed of two very important things. We have a body and a wick, also called shadows. Okay, so the longer the shadow, that shows you that there's rejection of either higher or lower prices. Okay, the bigger the body, that shows you that there's bullish or bearish momentum in the market. Let's go. Now that we have that out of the way, let's proceed. So let's look at some of the most important bullish reversal patterns. Okay, these are the I according to me, according to my experience, this is what you should focus much more, because there are a lot of there are a lot of candlestick patterns out there, and you cannot afford to know and master everything. But if you can know these few bullish reversal patterns, I think you'll be good. So what's the first one? The first one is very important. It's very familiar to you. It's called a hammer. What is a hammer? So a hammer is a bullish reversal pattern that is formed after price was either in a short or long-term downtrend. This is how you recognize it. So it has little to no upper body shadow or wick. The price closes at the top of the range, and the lower shadow is about 2 to 3 times the length of the body. Okay, and this is what happens. This is what it means. When price opened, the sellers took control and pushed the price lower. At the selling climax, huge buying pressure stepped in and pushed the price higher. The buying momentum is so strong that it closed above the opening price. In short, a hammer is a bullish reversal pattern that shows rejection of what? Of lower prices. Not just because you see a hammer doesn't mean you should buy immediately. Okay, so we need to wait for more confluence, wait for more confirmation before you can take a trade. Okay, so you don't just take a trade just because you see a hammer. No, you want to make sure that you have more confluence on your side. Remember, this is a game of probability, so you want to have that on your side. Okay, so for example, maybe finding a hammer at a trend line where you expect a bounce, or finding a hammer at support where you expect price to bounce off that support going up. When you see something like this, then you can take that trade. Otherwise, don't just take a trade just because you see a hammer. Okay, let's see its application. You see, we had the hammer here, and what did price do? Priced right into the upside. Okay, so and price after this was formed, price right into the upside. Okay, the next one is the morning star. What is a morning star? Just like a bullish reversal, just like a bullish, just like our previous candlestick, a hammer. This is also a bullish reversal pattern. That is one of the most strong bullish reversal pattern. How is it formed? Okay, this is formed after price was either in a short or long term up downtrend. And how do you recognize it? The first candle it has a bearish close. The second candle has a small range, which we call a doji candle, and the third candle closes aggressively higher than the first candle, at least 50%. Okay, and what does this mean to us? Okay, on the first candle, the sellers were in control momentarily as price closed lower, and on the second candle, there's indecision in the market. So the buying pressure and the selling pressure was in equilibrium. Therefore, it formed a doji candle, which is an indecision candle. And on the third candle, the buyers won the battle momentarily. Just like a hammer, just because you see a morning star doesn't mean you should buy immediately. Of course, these are strong bullish reversal patterns, but that doesn't mean that immediately you spot it, you should get into the trade. You always have to want to have confluence on your side. You want to have these happening at significant areas of value. Like that, you'll be able to take high probability trades. Okay, let's move on. So can you see a beautiful trade here? See what happened here. So this was the previous resistance, support, support. So this is previous resistance into support, and you spot a beautiful morning star there, and you're going to take that trade, and that trade would have worked out. Okay, of course these are cherry picked charts just to for us to demonstrate to you how these patterns formed, how these candlestick patterns are formed, and that their effect when they're spotted at significant areas of value. I hope you're getting it. Okay, let's move on. We have a bullish engulfing pattern. So a bullish engulfing pattern is formed just like the previous two candle patterns. It's formed after a short-term or long-term downtrend. And how do you recognize it? The first candle has a bearish close, and the second candle has a bullish close, which closes higher than the previous candle. This one, it's called an engulfing because it completely covers the previous candle. That's what it means to engulf. To engulf is to swallow, meaning it has swallowed the previous candle. Okay, that's a sign of bullish strength. And when you spot this at significant areas of value like support, trend line, then that becomes a hyperbolic trade. Okay, and what does it mean? The first candle has a bearish close and closed lower, and the second candle closes bullishly and above the first candle. Okay, which tells you that the buyers have won the battle momentarily. In essence, the bullish engulfing pattern tells you that you have overwhelmed the buyers have overwhelmed the sellers and are in control. And lastly, just like the other two we've seen, we don't just buy after we've seen a bullish engulfing pattern. We wait for confluence. Let's see an example on this one. Okay, so we have a beautiful bullish reversal candle here, a bullish engulfing pattern here, and it gave us permission to go up, and market immediately this happened, price went high and price went above. Okay, so these are very, very good and simple patterns that you need to master. What's the next one? So the next one is the piercing bottom. So a piercing bottom is a bullish reversal pattern just like the previous ones we've seen, and it is formed after price was either in a short-term or long-term downtrend. And how do you recognize it? The first candle shows rejection of prices, and the second candle retests the low of the previous candle. And this is also a very, very good bullish reversal pattern. And this one shows that price actually, this area was rejected twice, and this tells us bullish momentum. How do you recognize it? Let's see. So we had the beautiful, somewhere here we had a very beautiful piercing pattern, and when that happened, price went up. Okay, so those are the bullish reversal patterns. I believe that if you're able to master those ones and study them, I think you'll be good in terms of candlestick patterns, because those are some of the most important bullish reversal patterns. If you can master those ones, I think you'll be good to go. Let's look at the opposite, the bearish reversal patterns. So the opposite of the hammer is called a shooting star. Okay, so a shooting star is a bearish reversal pattern that is formed after price was in a short-term or long-term uptrend. Okay, how do you recognize it? It has low, it has no upper shadow, and the price closed at the bottom, and the upper shadow is about 2 to 3 times the length of the body. And what does it mean? Market opened, the buyers took control and took price higher. At climax, the sellers with huge selling pressure stepped in and pushed the price lower. And the selling pressure is so strong that it closed below where it opened. In short, this is a bullish reversal pattern, a bearish reversal pattern that shows rejection of higher prices. Just like the previous ones, we don't just enter the market just because we've seen a shooting star. We always have to wait for confluence. We want to find this happening at resistance. We want to see this happening at a trend line. Like that, you have a high probability trade. Therefore, the chance of you losing becomes very, very low. Unlike you just taking a trade just because you see a shooting star. Okay, let's see an example. Okay, see what happened? We had a beautiful shooting star where at resistance. So this was happening at a significant area of value, therefore it counts. Okay, let's go. An evening star, just like the opposite of a morning star. So the first candle, of course, is bullish, then followed by a doji candle, which is an indecisive candle, and then followed by a bearish candle, which closes more than 50% of the first candle. Okay, so this one shows bearish pressure. You want to find this kind of a candle at resistance or at a trend line. Like that, it can show you that there's pressure stepping in, there's selling pressure coming in, and market is about to reverse. Remember, these are reversal patterns, and you have to look to find this when price was going up. And when you see this at resistance, then you have some confluence. Okay, let's see an example. Look at this. So price actually broke this resistance, and there was an evening star. After this happened, price dropped like crazy. That's what you want to see before taking any trade. Don't just take a trade just because you see an evening star anywhere else. So you want to find these areas on significant areas of value. Like that, you take more significant trades. This is the opposite of the bullish engulfing pattern. It's called a bearish engulfing pattern, just like we said. Okay, So the first candle closes bullishly, and then the second candle closes bearishly and covers the previous candle. I mean, you don't have to go through everything. You can still read, but of course, this shows the first candle with a very bullish close and the second candle with a bearish close, and covers completely the first candle, which that's what it means to engulf, is to swallow, meaning it has swallowed the previous candle. Okay, so just like we've said, this is a sign of bearish pressure. It shows that the sellers have stepped in and closed below the first candle. For now, the sellers have won the battle, but for now, okay? And how do you trade it? Always want to find this at resistance. You want to find this when the buyers are losing momentum. You want to see that the sellers are stepping in, and sellers will step in at resistance and also at an descending trend line. Like that, you have more confluence and you can take better probability trades with high probability. Okay, let's see an example. Look at this beautiful engulfing pattern happening at resistance. So these are the kind of trading setups that you are going to be taking. Don't just have to sell when you see a bearish engulfing pattern. You have to wait for more confirmation before you can take any trade. Okay, I hope I'm not being too fast, and if I'm being too fast, please you can let me know in the comment section, and please you can feel free to run through this presentation. Okay, let's go. So this is the opposite of a tweezer bottom that we saw just some few slides above, sorry. So how does it happen? So this is a tweezer top. It's a bearish reversal pattern that is formed after price was either in a short term or long term uptrend. How do you recognize them? Remember, it shows price rejection. There's rejection of higher prices being rejected twice. Okay, the first candle shows rejection, and the second candle retests the high of the previous candle. On the first candle, the buyers pushed the price higher, and then they were met with some sudden pressure, and the sellers came in and closed bearishly. Okay, in short, it tells you that market has difficulties trading high, which it was rejected twice. Okay, this is a good bearish reversal pattern. So how do we see it? How will we recognize it? Look at this beautiful bearish reversal pattern which was formed here. It was formed where at resistance, and immediately this happened, price traded lower. So these are very powerful trends. These are very powerful signals. Okay, so whenever you want to take a trade, whenever you want to take a reversal trade, always look for these ones. If you want to sell, look for bearish reversal patterns. When you want to buy, when you think the market is going to reverse going up, look for bullish reversal patterns. These are very important. Okay, so what's the take home message here? So never take candle isolations, never take trades via just because you see a candlestick and you're like, okay, I'm going to buy. So never take trades based on candlesticks alone. Look for candlestick patterns occurring at significant areas of value. Confluence is very important. Confluence is very cardinal in order for you to become a consistent, profitable trader. And the trend is your friend. Therefore, trade with the long-term trend direction. You may not find this exact candlestick in real charts, Therefore, there are different variations. Don't hesitate to tweak a trade just because it doesn't look exactly like you've seen in this presentation. And always, if you're in doubt, please stay away. Okay, so this is the end of this very short and yet very informative presentation. Okay, please, I would really appreciate if you hit that subscribe button and also hit that like button. By doing that, you help us in the algorithm, and we're also able to provide you with so much information. Otherwise, thank you so much. May God bless you, and I wish you good trading.